Brad Williams, Frugal Finance. How about we look at the regression model? In the previous example, we touched briefly on running a regression. Well, subsequently, there's a model using regression. Let's discuss it. One way of calculating a hedge ratio for interest rates futures is the regression technique. The hedge ratio found by regression minimizes the variance of the combined futures cash position during the estimation period. This estimated ratio is applied to the hedging period. For the regression model, RGR, the hedge ratio is as follows. HR is equal to negative covariance of S of F divided by R. I couldn't find within lovely Excel my normal notation. R is going to represent the standard deviation 2 of F, where covariance S of S is the covariance between cash futures, and R2 of F is the variance of futures. As noted previously, this hedge ratio is the negative of the regression coefficient found by regressing the change in the cash position on the change in the futures position. These changes can be measured as dollar price changes or a percentage price changes. Perhaps you haven't looked at statistics, or this is so new to you, statistics is just a foreign subject. Regression is a powerful tool. This is not a course on regression or statistics. Hence, you know what I'm going to say next. Either open up your old statistic books or go online, buy a recent release of statistics for managers or something to that effect. Open it up and go to work. Start working out regression. Go online, start putting together regression and understand what regression's all about. So here we're going to have S and T, and that looks like the mean plus the change in F and B and what have you. Okay. Or this looks like it could be the regression estimate. The RJR model finds a hedge ratio that gives the lowest sum of squares error for the data used in the estimation. Using the estimated hedge ratio for actual hedge assumes that the relationship between the price change on the futures and cash instrument does not change dramatically between the sample period and the actual hedging period. This is a practical assumption. If the relationship is basically unchanged, then the estimated hedge ratio will perform well in the actual hedging situation. Fundamental shifts in the relationship between the price of the futures contract and the cash market good can lead to serious hedging errors. This danger is present in all hedging situations, but may be exacerbated in interest rate hedging. Without doubt, the RJR model has proven usefulness in the market for the traditional futures contract, and it has been adapted for use in interest rate futures market by Ederton, Frankel, and Hill, and Sneisel, whatever Thomas's last name might be. However, there are some problems in applying RJ to interest rate hedging. First, since it involves statistical estimation, the technique requires a data set for both cash and future prices. This data may sometimes be difficult to acquire, particularly for an attempt to hedge a new security. In such a case, no cash market data would even exist, and a proxy would have to be used. Second, the RJ model does not explicitly consider the differences in the sensitivity of different bond prices to changes in interest rates. As the example of table 616 and 617 indicate, this can be a very important factor. The regression approach does include the different price sensitivities indirectly. However, since their differential sensitivities will be reflected in the estimation of the hedge ratio. Third, any cash bond will have a predictable price movement over time. The price of any instrument will equal its par value at maturity. The RGR model does not consider this change in the cash bonds price explicitly, but the sample data should reflect the price movement tendency. Fourth, the hedge ratio found by minimizing the variability in the combined futures cash position over the life of the hedge. Since the regression hedge ratio depends crucially on the planned hedge length, one might reasonably prefer a hedging technique that focuses on the wealth position of the hedge when the hedge ends. After all, the wealth change from the Hedge depends on the gain or loss when the hedge is terminated, not on the variability of the cash futures position over the life of the hedge. In spite of these difficulties, the RJ model is a useful way to estimate hedge ratios, both for traditional commodities and to a lesser extent for interest rate hedging. Bottom line, do a little more research in terms of this particular modeling technique and then run simulations. And there are enough tools out there where you can run simulation and determine if there's a decent probability of this being an effective tool. Brad Williams, Frugal Finance. Thanks for watching.